I think the problem with, all of these things, it's what comes next. When's the next stage of so you get this burst in inflation, you get this burst. I think it's much stronger than people think. I think the employment rebound is much stronger. It's beginning to look much stronger than I thought, certainly. The wage pressure is much more embedded than people realize. I think this sets bond markets up for, right here, right now, maybe we get a bit of a pause. It's only because you're getting some of the sell-off in the equity market, and that, there's that natural feedback loop. But I just think fixed income is still grossly mispriced. The problem is going to be for the dilemma this sets up for central banks, because their natural inclination, and I've been saying to a lot of clients that the Fed kind of wants their cake and eat it. They want, and they've talked to policymakers, and obviously with Yellen in the White House or in the administration, you got this sort of symbiotic relationship they've got now to sort of underpin what Treasury is doing. And Treasury's planning, the numbers are insane, guys. And it's been very clear from a policy perspective that was going to come through. But so they've been saying, oh, we'll underpin this, don't worry, we'll help you, we'll do all these things. Well, what do they do if these numbers just become so great? I think they've got one of two options. The first one is they push back against government, okay, and they basically tighten on government. Okay, well,
so if dollar up,
bond yields up, front end of the curve crushed, but it would annihilate the US equity market, I think, right? The odds of you getting a huge, broad VAR shock, as we call it, value at risk shock. In other words, all risk models get stressed by that move, I think is so great, because you'd be talking Apple back at 1995, right? Exactly where it was pre-pandemic. I think that is a real risk. So you'd crush the housing market. The housing market would be annihilated, right?
You're talking about a raise in short-term interest rates, right?
I'm sure about, true tightening, but you're talking a blowout in Treasury yields. Treasury yields go up to 2.5, right? I don't think the economy can take that. Okay. Yeah. I do not believe, I think all these equity guys who stood up there and say, oh, we can go back to 2.5%, 3%, just don't realize the degree in which we've had PE multiplication since COVID, right? Apple PE went from 25 to 45 at the high. It's come down because their numbers were good. But look at Tesla's PE, right? It just went parabolic. And so that's one option for the Fed, right? They do what they typically do. Okay.
They're independent.
Yeah, they're independent. And the bond market is beginning to realize that is a risk, right? We saw it in 2013. Oh, no, we won't tighten. Oh, no, we won't tighten. Oh, yeah, we actually need to taper. What? You told us you weren't going to taper. Bloody hell. Right. Yours. Boom. Okay. Brutal. So that's risk number one. And that's option number one, right? And I don't know whether that's a valuable one, because I just don't think that we could clear the level of debt that's going to be issued. And the numbers are ginormous, right? We are running debt levels a Banana Republic wouldn't be allowed to run, okay? And we will be running those numbers for the years to come. So you just can't clear the market at a natural clearing rate, which brings us to option number two. And option number two is basically that the Fed gets in bed with government and truly does some sort of yield curve control stroke, essentially MMT, and that they artificially suppress bond yields in order to support asset prices and clear the debt.